If you're an investor keeping an eye on Canadian banks, you have got to look at what's happening with the Bank of Montreal. They are making a massive pivot, a truly huge bet on America. So today, we're going to break down that exact strategy and, more importantly, what it all means for the bank's future. So here's the big question, right? How does a bank that's been around for over 200 years, an absolute giant in its home country, find a new way to grow? That's really the core problem facing BMO. They've kind of hit a ceiling at home in Canada. And the answer to that one simple question, well, it defines their entire strategy today. You see, the heart of the issue is the Canadian market itself. BMO, just like the other big six banks, is operating in a really mature, stable environment. Now, that's great for consistency, don't get me wrong. But for big, exciting growth, not so much. To really expand, they had to start looking outside their own backyard. And here's that dilemma in black and white. You've got Canada on one side, offering stability, sure, but pretty slow GDP growth. Then you look at the U.S. Totally different story. There's just more momentum, a more resilient economy, and, this is key, a much larger, more fragmented market up for grabs. So for a bank hunting for its next big growth chapter, the choice was pretty obvious. Look south. Okay, from an investor's perspective, this is where the rubber really meets the road. BMO is a solid number 4 among its peers, no doubt. But look at that return on equity, the ROE. At 9.7%, it was lagging the pack, and what that means is that it was simply less efficient at turning shareholder money into actual profit. This wasn't just some abstract growth problem, it was a profitability problem. So, faced with a growth problem and a profitability challenge, BMO didn't just make a small move. They didn't dip their toe in the water. No, they went all in on the United States. Let's just take a second to appreciate the sheer scale of this bet. $16.3 billion US dollars. This wasn't just a big acquisition, folks. This was the single largest takeover in Canadian banking history. It was BMO planting a flag and making a clear, bold statement that its future was going to be defined by its success in the American market. And just look at the result of that bet. That Bank of the West deal completely transformed BMO's identity. It basically went from being a Canadian bank with some U.S. business to a truly North American bank. With the U.S. now making up nearly half its revenue, BMO has fundamentally changed where its profits come from. But here's the thing, a transformation of this scale comes at a cost, at least in the short term. The acquisition diluted the bank's overall profitability, and that kicked off what management themselves have called a crucial, all-hands-on-deck mission. Now, before we go any further, let's be crystal clear on this one metric, because it is everything for an investor. Return on equity, or ROE, is your yardstick. It tells you how good the bank is at using your money to make more money. A higher ROE means a more profitable, more efficient company. For BMO, getting this number back up is the whole game. You can really see the whole story of this mission in just 3 numbers. Before the deal, BMO had a very healthy ROE, over 15%. Then the costs of the acquisition knocked it all the way down to 9.7%. But now you can see the recovery is starting, with the adjusted ROE already climbing back to 12%. That journey, from that low point back to its former strength, is the central plot for BMO investors right now. And hey, don't just take my word for it. BMO's own leadership is as clear as day about this. Their words, our number 1 imperative is the ROE rebuild. When management is that direct, you know it's driving every single major decision they make. So all of this sets up the classic investment debate, doesn't it? The strategy is clear, the mission is defined, and now there are 2 very different ways you can look at BMO's future. You have the bull case and you have the bear case. Okay, the bull case is pretty simple. The big U.S. bet pays off, big time. BMO executes well, earnings grow, and as that ROE climbs back toward 15%, the stock's valuation gets a major boost. The bear case, though, is that the U.S. turns into a low-return quagmire, a super competitive market where BMO just struggles to hit its targets, especially if the economy takes a nosedive. So, as an investor, how do you track which of these stories is actually playing out? How do you know who's winning? Let's get practical. Here are the specific things you need to be watching in BMO's next quarterly report. Think of this as your personal dashboard. First, that U.S. segment ROE. Is it moving towards its 12% target? That's priority number 1. Second, watch the trending credit losses. If they're going down, that's a great sign. Third, net interest margin. That tells you how profitable their core lending business is. Fourth, operating leverage. Are they growing revenues faster than costs? And finally, keep an eye on those share buybacks. That's a powerful tool they're using to directly boost the ROE number. So, we're left with one big, overarching question. The chips are on the table, the strategy is locked in. Bank of Montreal has made the biggest bet in its entire 200-year history. The only question left is, will it pay off?